but I got a weird nootropic energy drink, so I'm all good.
Great. We love Warren's weird nootropic energy drinks. Cold open, leave it in. Just joking. Welcome to the Games Growth Update, your weekly top news, trends, and insight for the games growth industry. Research and brought to you by Upptic. Learn more about how teams and technology are driving millions of people to the world's best games at Upptic.com. So we'll jump right in. There's a ton of news to cover today, a bunch of interesting topics. We have earnings at the end, which we'll do a deep dive into. But how are you feeling, Warren? Feeling good?
I'm feeling good. We just got back in the flow of doing the news show. And for our first one, we had several months of crazy stories to catch up on. I kind of thought we'd have a slow week for this, but no, man, there's tons going on, tons I'm excited to dig into with you today. How are you feeling, Xander?
Chop some stuff, leave it on the cutting room floor, but that's good. We have a nice, tight, concise, insightful show for you today.
Nice.
Well, let's jump right in. This topic's a couple weeks old, but something that I thought was really interesting and we wanted to call out. So EA Sports FC hit 14.5 million accounts in the first month without the FIFA brand, which is from an article on VentureBeat. Haven't pulled those numbers ourselves, but I think there's something interesting to talk about here. So EA Sports FC hit 4.5 active users in the first week, which is up 40% from the same point 1 weekend in 2022. And this is after losing the FIFA naming rights. And I think that people were very concerned that losing the FIFA name would be a big blow to the brand. But what we're seeing is that basically the game itself is up, as well as EA is doing pretty well overall. And it's a pretty interesting brand study, right? Because people assumed that the name FIFA was the brand of the game. And I think that turns out not to be the case. It's a pretty interesting brand study in that, what is a brand actually? In this case, EA Sports is really the brand. People knew the quality that EA Sports brings, and the FIFA license is that's something nice on top. But it's probably pretty true that EA actually did more for the FIFA license than vice versa. So, Warren, any thoughts on this phenomenon?
Yeah, for sure. Just clarification: 14.5 million active users. We said 4.5, definitely more than 4.5 users. But yeah, I think that's true. I mean, if you think for the common person that's not a sports enthusiast, I don't think the brand FIFA honestly meant a lot until the video game franchise blew up. And we covered the negotiations when that came up between FIFA and EA. It seemed like both companies were approaching it from a position of pride on how much their side powered the video game franchise. And now the dust has settled, and it looks like EA has definitely come out on top of that. So it's clear that no one was playing these games. There's not the same amount of emotional attachment to the FIFA brand as I think that org negotiated. And in fact, one thing I'm thinking about a lot in seeing the success of this rebrand of EA Sports FC is anyone who does marketing for large games knows this, but I think it's worth talking through a little bit. Having a big IP is not all upside. These things are expensive. It's much more costly to have an IP associated with your game than not. And you hope that there's some amount of arbitrage of the increased conversion that you get from your marketing or the free users that you're getting from just the brand itself outweighs the cost that you're paying for this. And one thing I'm thinking about with seeing the success of EA Sports FC is how much does it help them to not have that licensing rate with FIFA in order to better power their marketing. I've worked on UA for games before where we knew we had to give away 20% of every dollar made to an IP associated with the game, which just ruined UA, which maybe normally that UA might have been 20% profitable. Now it's unprofitable. So I think that's just one thing I'm thinking a lot is we know what was lost, which was the FIFA brand, but what was kind of secretly gained, which was potentially extra margin on all of their marketing efforts and scaling this game.
Right, this was supposed to be a $100 million plus deal, and so that's a lot of extra money to push into marketing. And I think one important thing to call out here is that they also have all the brands for all the clubs and all the players. And so it turns out FIFA had assumed they had this consolidated point of leverage, and then the reality is they were just one amongst many IP. And, they also it's an IP with a pretty bad reputation now. Anyway, this isn't a soccer podcast, but I thought that was something that was interesting, a little branding lesson that I think was interesting for us to cover. Warren, what's next?
Yeah, let's go over to what's going on in ad tech M&A. So AppsFlyer, one of the major mobile measurement providers, acquired a company called Dev2Dev. Now, Dev2Dev may not be a name that everyone is familiar with. And what's significant about this is not necessarily how large this company was, but the role they play in the ecosystem and how this positions AppsFlyer. So what is Dev2Dev and what is AppsFlyer? How do they fit together? So AppsFlyer is one of the top several mobile measurement providers, big presence in gaming specifically, which is one reason that we track them closely and we work with them as we do with the other major mobile measurement providers. It's a primary marketing hub for your marketing analytics and attribution data, which user came from where, how did they monetize, what was your ROI? Whereas Dev to Dev is a company in the segment that we would call product analytics. So game analytics is another common product use there. There's a number of players in that segment. To date, most medium to large developers have had 2 SaaS contracts here. So they'll have their measurement analytics provider, an AppsFlyer, Singular, Adjust, etc. And then they'll have their product side or game side analytics provider, Dev to Dev, game analytics, whatever. We've definitely talked a ton internally about how it doesn't really make a ton of sense that these are 2 separate ecosystems. And one thing that we find a lot talking to smaller developers is they have one or the other and they think it does both. And I think a lot of this is just because of vague marketing from both sides of like, you're all-in-one analytics hub for everything you need to launch your game. Like that could be said for any of these platforms. So this is a really natural M&A process, and I think it's actually smart that they didn't go for one of the bigger names in product analytics because probably better ROI. Like it's more about can they accelerate from a tech standpoint of having coverage of this part of the ecosystem. So I think it's a really smart acquisition by AppsFlyer, and I wouldn't be surprised if we see similar moves or building in this sector too, because anyone that needs one needs the other of these services, and they rhyme enough and have enough overlapping data that it hasn't made sense that they've been these like disparate sectors. Xander, what do you think about this move from AppsFlyer?
Yeah, it's pretty smart, pretty scary for folks like Upptic. I mean, I think overall this is sort of an obvious thing. We've talked about it in the past. What's happening traditionally is most folks have game analytics tool, like you talked about, and a measurement provider, and they pull it all together into a data warehouse somewhere, built on top of it with Tableau or a similar tool. It's a really, really expensive process to do that entire thing, multiple contracts with a bunch of different vendors, plus a bunch of team time. What I imagine AppsFlyer is trying to move towards is like, hey, this is your one-stop shop for everything you need in your game. Now, I'm sure that AppsFlyer isn't that now. They are a leader in the measurement side. They're eyeing an IPO within the next year or two. And so I think painting a growth story for them is going to be really, really important. And they're fairly saturated in the mobile market overall, right? They're the market leader. They have the majority here. And so where do you go from here? And this is an easy story they can paint to the public market to say, hey, this is what's next. AppsFlyer are ruthless. They're up there with AppLovin, with like the most ruthless folks in the gaming industry. And so I think anyone who's competing against them should be on their toes and agile and look at this with clear eye. How much will this affect your business going forward if they come after your segment?
I will also say AppsFlyer really, and this sounds like a slight, it's not. Like AppsFlyer are very good at upselling their customer base.
Yeah.
So they have a lot of low cost to free models that I've seen them onboard with customers. And then as you get in their ecosystem, there's upsells to unlock things like better cost reporting, tools used for retention and remarketing. And from a tech standpoint, if there is, this is one reason that like from a tech standpoint, we're always saying nice things about Unity, is like it's already in these game ecosystems. If it could be such that like, oh yeah, you know how you put in our product analytics SDK that was low cost? Well, you can actually just flip a switch and you'll already have an MMP online. So why would you want to bother to get a separate contract, work with a separate provider? Just flip the switch and enable it, and we'll add it to your invoice. So I think it's very, very powerful and looks. I don't know the value of the deal, but I would bet that this is going to pan out well for them.
Yeah, and they're always very good at painting the story, right? Their marketing team is massive. Their go-to-market organization is massive. We'll see how much of it exists right now, but it's definitely something that we need to be thinking about as we continue to build out the Upptic platform. So yeah, there's like some insight into our go-to-market strategy.
So up next, it's earnings season. Since the last cast, we got a ton of earnings in for gaming companies, for ad tech, and that surrounding ecosystem. Xander, I know you like to talk earnings every quarter. Where do you want to start? We got a ton of numbers to go through. Let's parse through some of these and see if we can identify some high-level trends from this earnings season.
Yeah, there's a few segments here. I think we'll talk about PC, console, mobile, and then we'll call ad tech. There's a lot of overlap, but I think that's just a nice way to categorize it. So we'll start with PC, console. Warren, do you want to walk through some of the top line numbers for PC, console?
For sure. So yeah, just looking at some of the bigger players in the PC and console space, overall it's looking pretty healthy. So Sony reported sales of $18.5 billion, which was up 8% year over year. Net income of $1.32 billion. That was down by 29%. But game and network service sales were up 32% to $6.31 billion. Then Nintendo also reported net sales were up 21.2% year over year, up to $5.3 billion. Their operating profit was up 27%, so looking quite bullish as there. They also raised their profit forecast from 2.3 billion to 2.8 billion. And then what else? Take-Two, we got their numbers. Take-Two was down slightly, 7% year over year with a net loss of 543 million. So they are down a bit. Take-Two is interesting because they're a bit of a hybrid, right? Big subsets of the company in PC, console, and mobile.
And this is, I think actually interestingly, is this the first full year comp where they actually have Zynga as an operating segment? And so this, spoiler alert, we're talking about mobile later. Yeah, this could be a part of the mobile story, which is that they don't break out Zynga as a segment, but that could be what's driving this down.
Yeah, that's interesting. And then lastly, just around, we do have EA's numbers, pretty flat. They were up 0.5% year over year. The revenue was up 0.5%, but net income was up 33% to 399 million. And then Xander, I think you have some numbers from the mobile sector up next, right?
Yeah, so I mean, let's unpack this a little bit. We're talking about mobile, we'll talk about ad tech. But what it seems like at the top line is like, this seems to be the healthier segment of the games industry overall. I think specifically people like Sony and Nintendo, it's very clear that PC console is still a growth segment and that's a place where we're seeing pretty meaningful increase in revenue this year as compared to last year.
Put another way, it's like they haven't had the headwinds that mobile has had.
Sure.
I think there's two things. One is like it's been a bit of a banner year for quality in PC and console. We've talked about that a few times. But we talk a lot about the performance marketing landscape. It's starting to mature for performance marketing more in the PC and console side, so opening up new vectors for growth, whereas that has been collapsing and getting harder and harder for mobile free-to-play, which is the sector that's dominated the last decade, right?
Yeah. And like Take-Two is not crazy. I mean, that's very cyclical. Like they're the GTA company, first and foremost. GTA 6 is coming out soon. I expect them to have a banner year / 5 years when that comes out, considering how they've been able to milk GTA 5. Yeah, I think that this segment at least has a long, healthy road ahead of us. Let's talk a little bit about mobile. And for this segment, we're going to talk about some of the mobile games companies specifically. And this is just sort of a smattering that I pulled numbers on. Playtika down 2.5% year over year, $630 million in revenue. Skills down 38% year over year, $227 million in revenue. Double Down 7% year over year, $730 million in revenue. Stillfront down 6.5% year over year, $158 in revenue, assuming I converted that right from
158 million, yeah.
Okay, so I won't run through all the income because it's kind of like, it's a lot, but I think there's something also interesting that's happening here, which is that some of these companies are actually increasing their net income overall, basically their profitability, or shrinking their losses. And so I went through and I looked at where this came from, and the biggest segment overall that we saw is basically a decrease in operating expenditure, which you can read as UA spend. And so a lot of these companies are doing something pretty interesting. Stillfront being the obvious, Stillfront UA spend is flat, but some of these companies like Skills and Double Down, they're cutting their UA spend pretty significantly, which is increasing their overall profitability. And that's fine for a quarter or maybe 2 quarters, but you and I know that if you cut UA over time, the game degrades in its ability to generate revenue. And so this is like kind of a flashing red, at least yellow light for me in my mind, that like these companies need to really, really figure out a way to retrench and reinvest to continue growth, because otherwise it's going to be a bloodbath going forward. Any thoughts on that side, Warren?
Yeah, so many thoughts. I mean, there's 2 ways to look at this. Like, we're obviously big believers in the power of user acquisition done right, performance marketing done right. Like, we built our reputation off that. But at the same time, for years now, there's been incentives in the market to do unprofitable top-line user number growth. Right. For exits and for vanity metrics, for any number of reasons. And with the clarity of time, we've found that so many of these like really aggressive UA stories didn't have something healthy underlying them. With the current market conditions and investment in gaming going way down, this is like repeating a narrative we've talked about a few times, but I'll get on the soapbox one more time. We're seeing that companies are saying like, well, this UA is not really making us money, and it's getting harder. So let's just like either bow out or just really narrow it down to only our strongest games or only the subset of UA that we still think we can execute profitably. So I think it's actually a short-term healthy move, because not calling out names or saying that that's specifically what some of these companies did, although we definitely have opinions. But I think that some of these companies are actually tightening their belts pretty well by just like removing unprofitable UA strategies that were like making their top line numbers look better year over year or making their overall user numbers, but it wasn't turning into a story of ongoing profitability. The other side of it, to your point, Xander, is like eventually these companies have to find ways to profitably grow their user bases. It's not either or of acquire users at a loss or don't acquire users, which like right now, it feels like they've cut cost and are letting those older cohorts mature and still getting revenue from those. But at some point, you have to find like a sustainable user acquisition run rate. And I think, each of these companies is approaching this differently. And we're not saying any specific companies here are guilty of this, but that's just a theme I've seen in the space for the last couple of years. What are your thoughts on these trends we're seeing in mobile?
Yeah, I agree with everything you said. A lot of these companies were unprofitable. The question remains in my mind is, what of these companies are actual viable businesses, right? Like how many of these companies are actually more subsidized by zero interest rate environments and potentially you have to have further cuts in order to have, positive go-to-market playbook. I'm not sure. I don't have a clear opinion. I mean, I have opinions on specific game companies, but we're not going to do a deep dive.
Well, I have a question, Xander. What do you expect to see next year? We're seeing signals that inflation is finally going down. We might be ceasing with further rate hikes and starting to, it seems like the investing pocketbooks are starting to open back up and we're seeing more new titles being announced to go to market in the next year. Just on the BD side for Upptic, we're having more teams like reaching out to us about game launches lately. So what do you think next year is going to look like when we talk about these numbers? Like, do you think we're going to see teams? Yeah. Well, yeah. Or just in general for our industry, do you think we'll see people investing in growth more aggressively next year? Or do we think this is a new normal?
Well, I think roll-up is going to continue, right? I think we're kind of still in the early innings, end of the third, when it comes to sort of the zombie mobile companies. There's going to be a couple big consolidated winners, and I expect to see companies like Skills or others that will continue to get roll up and get snapped up by either like private equity or bigger public companies, and they'll just sort of milk them for the long term, right? Because these are basically steady state cash flow businesses, and it's a game of how long can we smoke this cigar butt, to use a Warren Buffett term. And then I think we're in the very early stages of sort of the next generation. And so those are the folks we're talking to mostly, although not completely. And I think we'll see some reasonable continued investment and hopefully more moderated growth going into next year, assuming people can figure out playbooks at work.
I think there's one other piece to this, which is like, I'm finally starting to see more companies starting to have ways to work around iOS. Again, it took a long ass time. Obviously, we're super biased here. Like Upptic built our own tech around like working around iOS privacies for scaling UA. But last year, I would say it was the norm. 90% plus of companies I talked to had no viable way of measuring their iOS long-term ROAS from their marketing campaigns. Now it's like more teams that actually have like a proof of concept or some tech that they're licensing, some way to navigate this.
Right.
So just opening up iOS again as a growth channel with more competition in it, I think that's going to revitalize next year a lot. We talked about both healthy and unhealthy UA. I think we're going to see an uptick in healthy iOS UA gradually next year as well too.
Yeah, agreed. And if you need help with that, hit up me or Warren. Cool. So the last segment I want to talk about is ad tech, and there's two companies specifically, which are sort of the yin and yang of the ad tech ecosystem. And we talked about them last week, and I think it's interesting to talk about them again. So both AppLovin and Unity reported their earnings. We'll start with AppLovin because it's a very, very different story than Unity. AppLovin reported revenue of $864 million, up 21% year over year, with net income of $109, up 340%. year over year. That's some pretty crazy growth in a segment that is overall, like we just talked about, mobile is a struggling segment right now. And I hopped on the earnings call and listened in live, and they're pretty forceful and proud around their strong performance this quarter. And I mean, to be clear, it's impressive growth when no one else is growing. And so, I kind of wanted to dig in a little bit why we saw the performance that we did. And luckily for us, we have folks on our team whose job it is to buy ads from these folks all the time. And so I went and I spoke to some of our UA experts on the Upptic side. And I asked them, so what's going on with AppLovin? How is performance? What are the trends you're seeing? And one of the things they said is like, hey, well, listen, they're very, very heavy into exploring new inventory. That is, they'll test broadly across a ton of inventory, whether or not it's profitable. And on top of that, they only take monthly budgets into account. So they'll drastically overspend on a daily basis, which is, I think that's very non-standard. If you set a daily budget, most companies are expected to remain within that daily budget.
Well, in fairness, I'd say there's a lot of guilty offenders in the algorithms of the ad network that take the maximum budget as like a light suggestion rather than a hard rule. So definitely like that's a trend we saw with AppLovin, but they're not the sole ones guilty of that to be
sure. So that's a piece of it. I think the thing that to me was most interesting and probably indicative of their behavior as opposed to how other people behave is they generated banner ads across multiple clients that we had on their own without telling anybody and pushed spend heavily into these banner ads with no regard for performance and without telling anyone on the team. And that's pretty crazy, right? Like to basically generate your own ad slot and then push a bunch of ads through it and not let anyone have to catch it on the back end. And imagine if they're doing it to us, they're probably doing that to a bunch of other folks across the industry. And so, I mean, they've always been someone they're very, very cutthroat. They do whatever it takes to increase top and bottom line. And so, it's not crazy to imagine that with those type of aggressive tactics that you're seeing such aggressive growth for the company overall. Great for the shareholders, not great necessarily if you're the one having to buy the traffic. I know, Warren, what do you think about AppLovin?
Yeah, and just to add clarity to that second thing, so there's, I'd say, a unspoken but implied agreement with every ad network that you know what you're buying from them. So yeah, I think a lot of teams were frustrated to discover that like AppLovin, with the intent that they're buying like rewarded video inventory, which has a certain expected performance, that there was all of a sudden a large amount of like static banner inventory that was coming in that was not communicated ahead of time, as far as I know, to most developers. That was, just these ads were generated on their side. So, there's nothing implicitly immoral about that, but it's aggressive to say the least to introduce like something that's quite different and usually has quite different performance metrics than what the buyer believes they're buying. So when I saw AppLovin's initial numbers, my first thought was like, it's surprising in the current climate and the overall spend trends. But we know that, like, to say it a nicer way, AppLovin is a very savvy financial operator and will find ways to be profitable when their competition can't, right?
Yeah, I mean, they're, like I've said it for a long time, I think they're one of the scariest folks in the ecosystem just because they're so savvy and they're very, very cutthroat. And as an AppLovin shareholder, it's great. And as anyone else, it's maybe less great. It's really interesting, though. If you listen to the earnings call, they really, really focus on talking about growing the ecosystem. That's their whole thing, growing the ecosystem. So talk more about that later. Sort of a similar but disparate story is that of Unity. Unity reported revenue of $544 million, up 69% year over year, with a net loss of $125 million compared to $250 million last year, which obviously is really, really positive and healthy growth in the right direction, but they are not profitable. And there's been a lot of concerns about the Unity growth trajectory overall. And on top of that, you might have heard Unity had an issue with their engine and rolling out a new feature for the engine within the last several months. And boy, have they made some changes. So Unity suspended guidance, and they're currently undergoing a reorganization. What they've announced is they're going to cut products starting immediately, which will mostly resolve in Q4. Talk about what we think is going on there. But then they'll also be doing layoffs and reducing their office footprint. And so this is like basically as drastic of an action as you can take. And it is not completely unexpected, but it is pretty severe. And if you have listened to me talk about this at all, I'm very, very bullish on Unity on the long term. I really think that they have such a huge competitive advantage. But it's crazy to note that they did all this in one fell swoop, and the stock got like hammered the day they announced it, although it's bounced back really, really comfortably since then. So Warren, I got a lot of other thoughts here, but what do you think about sort of the Unity's playbook so far?
I mean, Unity has everything in front of them in order to be crazy successful. We talk about their unique positioning is like a repeated theme on this podcast. And it's really, to me, it's a story of putting the puzzle pieces together optimally, removing redundancies. Like, it's inevitable that at some point there's not going to be Unity as an ad network and ironSource as an ad network. They have the same underlying core product. Ultimately, they're going to be, I think, powered by the same SDK. It doesn't make sense to have like completely separate teams of ad ops and account managers.
Yeah.
And yeah, I think with ironSource coming in as being like laser focused on knowing how to operate an ads business, my guess would be, if not in name, at least in personnel, a lot of the leadership from ironSource drives that part of the business. I think that's going to be better for everyone. I mean, we talk all the time about like Unity's like unique positioning of just like already being the DNA inside these games. And the same thing we're saying about AppsFlyer and flipping a switch to unlock game analytics. It's the same thing with games built on Unity and flipping a switch to unlock ad monetization. So if they, I don't want to say get out of their own way because it's more complex than that, but the change in leadership is probably due. And they have now all the pieces within the company to just totally dominate if they get some operational efficiency and like clear vision for where this is all going. I don't know. That sounds like some word salad, Xander. Like, what are your thoughts on the Unity situation?
I mean, I think you're right. I mean, the single biggest, largest bet I've ever made in my investing career is that Unity is going to grow over the long term. And so I'm obviously very, very, very bullish on them long term. I hope that's not misplaced. I mean, I think, like you said, there's a Unity ads team and an ironSource ads teams. That's redundant. They're going to cut one of them. I imagine Level Play, which is the brand they just bought and is the one with like the better brand in the ecosystem, is probably the one that stays. That's the ironSource product. Who knows? But, overall, I think this is necessary. And what they basically said is suspended guidance, let us reorganize for this quarter. They have a new interim CEO. will announce a new planning to you at the Q4 earnings, and you'll be happy. That's what they're saying. Trajectory looks healthy. We'll be happy. I hope they're right. So that's sort of the high level. I went and similar to how I talked to our AppLovin UA experts, I asked a little bit about our Unity experts, but how Unity performance was going. And they said it's definitely a roller coaster in terms of performance, the machine learning, internal management and changes. There's a lot of softness across a lot of apps and led to us spending less on the network. And so we even had to pause the channel for a few weeks and restart and restructure the campaigns. And so it's like, what I'm seeing in both the scenario on the AppLovin side as well as on the Unity side is what we're seeing internally reflects what we're seeing in the public markets. And so it's just another validating point as to why these changes are being made. But yeah, I think overall it makes a ton of sense. I'm very excited to see how Unity goes forward. You could have made a lot of money shorting Unity on the earnings call and buying the stock right after. Not that I know anyone who did that, but yeah, that's our thoughts.
Yeah, we talked about it before. In the last episode, we talked about this potential, they tried once before, but potential AppLovin making another move to acquire Unity. But one thing we talk about a lot is like if you take Unity's position matched with AppLovin's operational efficacy and ruthlessness, that is a true behemoth of the space. So now is probably, we talked about this last time, but like if there was ever a time to like make a more aggressive play for it, it's probably now in this moment of weakness for Unity. So it's going to be, I'm very curious to see if we get a AppLovin going after Unity round 2.
Yeah, well, so I haven't looked this morning, but basically the stock is up like 40% or so from what it dove on
Unity?
the last week. Yeah, it's up like pretty substantially. And they also have like over $1 billion on the balance sheet. So they have the war chest. I think Apple would love to buy them. And like that's my like fantasy draft, but I don't think they don't really have the resources to do it. So we'll see. Cool. Well, that's our take for this week. Let us know if you have other interesting topics you'd like us to cover, and we will speak to you next week.
Thanks, everyone. See you next week. As always, the pod was brought to you by our team here at Upptic. Here at Upptic, we do all things to help games grow, games of all shapes and sizes. We work with small indie devs up to some of the largest games in the space today. So we work across technologies. We work with mobile free-to-play, with PC console games, with Web3 games, and we just love being at the forefront of where games are going and helping them grow. So if you're working on a upcoming launch and you need help with user acquisition, creative development, analytics, and data modeling for things like iOS privacy, we help with all that stuff for your partners to launch your game. You can reach us at upptic.com. That's upptic.com.
Talk soon.